Having been to many real estate conferences all around the US, I can tell you with a high degree of certainty that opportunity zones are the single hottest topic in the real estate investment sector right now. However, there is still a lot of misunderstanding about the vehicle and the tax incentives and what is certain, what is kind of a gray area, and what is to be determined. So I wanted to have an expert on the program to clarify, what's currently in place, what is up in the air, and where the real opportunity in the opportunity zone exists. So in this discussion, we're going to talk about the unique benefits of the opportunity zone. To be honest with you, there has been a history of tax incentives, tax loopholes that the government has created to incentivize certain things. I don't think there is a more pronounced example of a specific tax loophole that can benefit real estate investors ever than something like this. It is pretty remarkable. The entire real estate sector is going to benefit because it's not just investors of real estate, right? It's people that have been able to invest in stocks, bonds, and mutual funds and now have the opportunity to sell that and potentially roll those gains into real estate investments. In this conversation, there is a bombshell which is dropped, which I did not know that should be known. And it's about the date at which the data was used to establish where the opportunity zones will be. This is particularly compelling for California investors. I'm not going to give it away. You have to listen to the interview, but trust me, it is really interesting. And there has been a lot of misunderstanding in terms of who has accurate information, what's coming directly from the government. We will discuss where you can get accurate information about the most up-to-date laws on the opportunity zones, because this is something that's changing every single day. Now, I just got off the phone with someone who graduated from the Q2 2019 mentorship program, and I'm telling you, these individuals are really crushing it. For those of you who don't know, I created a mentorship program for passive investors, capital raisers, real estate entrepreneurs about a year ago. And since then, we've conducted the mentorship program on a quarterly basis, and I can honestly tell you it's one of my favorite things that I've been able to work on. We usually schedule the calls from 5 to 6 p.m., and I've usually worked somewhere between 9 or 10 or even 11 hours at that point when the call starts. At the end of the call, I'm just completely invigorated. I'm super passionate about helping people achieve their real estate goals, and this has been an awesome vehicle to facilitate that. We have seen a lot of momentum for the people that have graduated the program because it's been a couple months now. And the thing I like most about it is that it's helped people that were trying to accomplish pretty significantly different things. So there's some people that have gone through the program, which are high income earners that want to take passive investing more seriously. Some people are recent college graduates. They want to work in the real estate sector, may have not studied real estate in college. They want to be familiar with the vocabulary in terms of going into a job interview. And there's some full-time real estate entrepreneurs, full-time investors that want to take their career to the next level. And all of them have learned a lot. This is something that we've received repeatedly, positive feedback. Like I said, it's something I'm really proud of. And this is what motivated me to reopen the program for Q2. So if you're interested in learning more about this program, really trying to supercharge your learning curve, because only so much can be covered in a conversational podcast. There's levels to this game. We went to the highest level that I could possibly bring for a mentorship program, and it's available on this website. So if you head over to cfcmentorshipprogram.com and click apply now, my partner Adam Carswell will reach out to you and schedule an introductory call. And if you're interested, if this is then the kind of thing where you've listened to a bunch of episodes, you feel like you want to take it to the next level, this is a great medium for that. Or if you listen to a couple of episodes and you feel like you're not quite getting all the points because you're not as familiar with some of the vocabulary, it's great for that as well. And on the other side, if you're a full-time investor and you've been wondering where the experts are looking in terms of things like due diligence, is a great vehicle. So overall, go to cfcmentorshipprogram.com, click apply now, and we'll reach out to you. All right, hope you enjoy the episode. How's it going, everyone? Our guest for today is James Bohan, who is the founder and principal of Stonehan Capital, an emerging manager focused on opportunity zone investments and short-term debt. Additionally, James is a CPA and acts as an outsource CFO, provides CPA services to real estate investors and investment managers. James was previously the CFO at Mosaic Real Estate Investments, where he oversaw all financial matters of private debt with over $700 million of originations, and an investor base of hundreds of high net worth individuals and institutions. Before his time at Mosaic, James worked in the private equity real estate division of KPMG and its acquired firm Rothstein Kass, which is a market leader in the alternative investment space. Between James's background as a CFO and a CPA and a institutional investment manager and a tax advisor, he has the perfect background to execute on opportunity zone investments. Well, first of all, thanks again for coming on. This is obviously a topic which is extremely exciting. So we're going to talk about opportunity zones today. This is something that I get asked all the time. But before we even jump into that, let's start with just a little bit about your background and how you got interested and involved in the real estate sector as a whole.
Sure. Thanks, Hunter. And it's a pleasure to be on here. Thank you for having me. Firstly, I have been interested in real estate pretty much my whole life. I grew up in a family of developers, kind of learned about the industry at the dinner table, and always thought that some way, somehow, I would be in the real estate game. Well, I went to USC for undergrad, majored in accounting and business, and I graduated at the perfect opportune time of 2008. You know, with hindsight being 2020, that actually is an incredibly opportune time to get into the market when everything's down. But the fact that I didn't have the wisdom that I do now, I didn't quite, have the opportunity or background to capitalize on that opportunity. So instead, I leaned on my accounting degree. I always figured that people needed their books counted in up or down market, and went and became a CPA. And so I worked with a firm called Rothstein Kass that specialized in private equity and hedge funds and this kind of emerging alternative investment industry that has really grown over the past couple decades. And within that program and firm, I specialized in, kind of private equity, real estate taxation, going through complicated tax codes, organizational charts, and serviced, clientele with over $10 billion of AUM and advised on over $2 billion worth of real estate transactions. And it was a really great experience. And I'm glad that everything worked out this way for me because it really gave me a great foundation to start my career there.
Interesting. Okay. So this is the thing. When it comes to accounting, obviously you have certain personality types. You get extremely experienced, you get extremely detail oriented, and then there's not a lot of accountants that really make it out of that world because it can be very lucrative and you know so much about something that is so important. How did you end up making that transition? Like, how were you really motivated, and then not only motivated to do it, but also motivated to take action? Like, where did you see the long game taking you when it comes to real estate?
My friends, fellow CPAs and I joke around and we say, do you want to be the one counting the money or do you want to be the one making the money? And so I got to this kind of, career divergence path when I was at RK, where I realized in order to excel at the CPA profession, I had to, learn the tax code, all about real estate backwards and forwards. And I thought that getting into the principal side of the business was more rewarding for me personally and kind of better fit my skill set, expertise and history. So around the same time, Rothstein Kass was being acquired by KPMG, and I really loved RK and where I worked there. We had a great firm, and I was very lucky to be able to have some experience working for KPMG. And at the same time, I went back to get my master's degree in real estate development from USC. And this was a great kind of year of learning for me where I was able to work at a Big Four accounting firm, understand what it's like to do that, as well as go through a really concentrated master's program specifically of what my passion is, and that's real estate and real estate development.
Got it. So that's when the onion was starting to get peeled back and you were like, I have to make this decision. But at the same time, you're able to still get the income coming in while you were going through that process at USC, which is rare and probably, I'm assuming, extremely challenging given the workload there. So good to know. Let me ask you this. Just given the fact that you've had that background, you've took the real estate education, the formal real estate education very seriously. Would you suggest someone, let's say you had a son or daughter that was interested in real estate, would you suggest that they go that route, get their master's in real estate development, something like that? or go work for a firm, or start a company if they wanted to be entrepreneurial?
Any of those paths can lead to success. I think it really depends on what the timing of someone's life looks like. For me, it just kind of worked out naturally with this progression. I think going from an undergraduate program directly to a grad school program, whether it's an MBA or an MRED, really stifles your development. Because I feel like I learned much more in my CPA career over 5 years with institutional firms like RK and KPMG than I really did in school. But that being said, taking that experience of seeing all these kind of different businesses that I consulted on and having that framework and understanding and then going back to grad school, it made that experience much more valuable. And I was able to add real life stories and examples to the classroom experience and help my classmates understand certain things that I wouldn't if I had just jumped directly from an undergraduate program into grad school.
Got it. Okay. Well, thanks for clarifying that. So, and I agree, there's different paths for different people. And I've seen and interviewed a lot of people that are extremely successful with a variety of different backgrounds, real estate and non-real estate. Real estate just seems to be one of those things that draws people in. It's very lucrative. It has the potential to create passive income, many things that all listeners are very familiar with. But I think it needs to be reemphasized that the institutional, formal, educational thing can produce incredibly intelligent people with incredible relationships, which is one of the reasons people like to go to school. And also just the straight up entrepreneurs that find themselves surrounded by a great network of people that have a thorough understanding of the business. So thanks for kind of clarifying. So let's talk about this topic, which I know that you've probably gotten hundreds of emails about this topic. People know that I'm not really focused on this niche, but I get contacted about this all the time. Just basically who, what, and when, where, like what is it? How can I be involved in it? Are you getting involved in it? What are the risks, et cetera? So that's really the point of this entire conversation, to answer a lot of those questions so that people can send this podcast out to maybe help their decision. So before we even get into that, how did this thing start? What's the background here? And then also, where does it stand today?
Yes. So this has a long history and kind of long roadmap to getting to where we are today. So this really originated through a think tank called the Economic Innovation Group, or EIG, which was really spearheaded by this guy, Steve Glickman, and Sean Parker, who many people will know from his Napster days or Facebook days. So this EIG had this idea that in order to spur investment in the economy, that there was a large amount of capital and unrealized capital gains essentially sitting on the sidelines. And according to a 2014 study, at the end of that calendar year, there was $2.26 trillion in untapped capital gains. So that's basically saying, like, if you invested in Google and wrote it up for 10 years and never sold, that unrealized appreciation of you not selling is still capital that's invested in the market, but it really hasn't been recycled into the economy one way or another. So this think tank thought that we need to find a way to help, free up this capital. And these guys kind of really came from a venture capital and private equity background and kind of had the lens of that when they were developing this policy. So what eventually came to be was the creation of these opportunity zones in order to spur investment of recycling this capital from unrealized capital gains, and also having an incentive to invest into low-income communities. And that's really how this opportunity zone program got started. And it had a lot of bipartisan support and was something that was added to the last tax act at the end of 2017.
Okay, got it. And from my perspective, so many people that have a business model around explaining new tax loopholes, or however you want to call them, tax advantage situations, everyone was like, this is happening. This is one of the most significant changes in the tax law in 30 years. Here's what's happening, and here's where we think it's going to go. So since those initial things have come out, it's my understanding that there has been a lot of move towards codifying what it's going to look like going forward. Is there still some uncertainty in terms of how this will play out? Like, how serious down the road of determining how this is going to play out are we in terms of the difference between 2017 to where we are today in 2019?
Yeah. So really where this came out at the end of 2017 is that the government said that each state can designate opportunity zones based on certain metrics of being, low income areas. So while the program officially started in kind of 2018 when the rest of the Tax Act did, there really wasn't enough information to get going on this until about around mid 2018 because none of these zones had been officially designated. So around mid 2018, the states had all finally gotten their maps together and designated which zones they wanted to be opportunity zones. And then the US Treasury approved those maps. So now we're looking around mid 2018. Now, the Tax Cut Act or Tax Act explained in, the IRS code how the rules governing these opportunity zone investments would work. But the IRS code often leaves a lot of gray areas or room for interpretation. So what happens after that is the US Treasury will work with the IRS to come up with what are called proposed regulations. And that basically means how the IRS and Treasury will interpret the rules of the code. So where we are today is we've had a couple rounds of these clarifications coming out. The first major one came out in the fall of last year, around October, November. And we just got another set of clarifying comments in April of this year, about a month ago. And for me, the rules and regulations and clarifications that came out in the fall of last year were enough to get moving. They kind of helped explain how capital can come into a fund, how those funds can invest that capital, and kind of helped explain the rules around it. And once these further clarifications came out in April, it's really been off to the races. There's a lot of investors and investment funds kind of sitting on the sidelines waiting for these rules to come out. And since these April regulations came out, there's been a lot more transaction volume in this market. Now, that doesn't mean there's still not uncertainty. There's still certain specific topics and tax items that, need further clarification. And at the same time, these are still proposed regulations, and the US Treasury and IRS has to make them final regulations. So they've been open for comment from tax professionals and investment funds. And we're hoping to get hopefully either more proposed regulations in the coming months or final regulations very soon as well.
So give me an idea of how significant these uncertainties are. So for example, it's basically on the table that, well, we'll get into the parameters in a moment, but like from your perspective, is it 20% solidified, 80% solidified? What the range in there in terms of what really matters to people, like the reason that they feel motivated to pursue these types of investments?
Yeah, I think the tax advantage of them are really what is driving so much interest in this. And I can spend a minute to talk about that. And then I think a lot of people are looking at these investments and thinking that they pencil, economically, even without these opportunity zones. And so to them, it's just more or less the icing on the cake.
Okay, got it. So let's talk about the parameters. What does this look like? What is the advantage? What's the minimum hold period? Things like that. What are we getting into here?
So we're really looking at a kind of threefold advantage here. So really the first advantage is a deferral of paying capital gains tax. So let's say you have $100 invested in a stock and that stock is now worth $200. So if you sell that stock at market price of $200, you can now invest the gain money into what's called an opportunity zone fund, which is just a fancy name for any LLC or limited partnership or basically any type of legal structure. And you don't pay capital gains tax on your $100 of gain until 2026 at the earliest, or when you sell your opportunity zone investment. So you first get a benefit of having a deferral of paying the tax. And, having to pay money later is obviously better than paying money now for two reasons. One is because dollars in the future will probably be worth less due to inflation. And also because you can use your money now to make other income. So benefit one, deferral of tax. Benefit two is if you hold your opportunity zone investment for at least 5, even 7 years, you get a step up in basis. So on that example before, if you hold it for 5 years, you get a 10% step up in basis. So now your $100 basis in your stock is now $110, you only pay tax on the $90. If you hold it for 7 years, you get a 15% step up in basis. So your 100 basis becomes 115 and you only pay tax on $85. So that's benefit two, is you're paying less nominal dollars as well. So the tax gets deferred and it gets reduced. Now, the third benefit, which I think is the best benefit, is that any gain that your new $100 investment makes, if you hold that for 10 years in an opportunity zone, any gain on that new reinvestment is tax-free if you sell it after 10 years. And that to me is just an incredibly great incentive to invest in these areas.
Yeah, absolutely. And I think to your point, this is really substantial. I mean, capital gains tax, especially since you can literally take it from stocks, bonds, and mutual funds. If this was a few years ago for me, just as my personal situation, I was selling a lot of stocks, 5 or 6 years ago and putting it into real estate. So if this had been around back then, I would have been jumping for joy. Now I don't really have many stocks anymore because I've made that transition into this as I was taking this on more and more and more. But it's very interesting for someone that, let's say, for example, that you just recently found out the benefits of investing in syndications. And you're like, I'm going to convert my entire portfolio out of stocks, bonds, and mutual funds and into syndications. Well, this would be a really interesting conversation for you in particular because of the gains that you've likely experienced over the last 10 years or so. So let's talk about some of the limitations here. Like, what do you have to do other than the areas which have to be predetermined by the states? What are some of the things that you need to accomplish in order to get the favorable tax outlines that you just summarized?
Right. And to further clarify, it can be any gains. Even Bitcoin gains can be invested into here.
Great point.
As well as real estate gains as well. If you've sold a property and you don't want to 1031 it, you can, invest your gain money into an ozone fund from that as well. So some of the considerations and intricacies of this are that the investment that the qualified opportunity zone fund buys has to either be an original use in the opportunity zone or must be substantially improved. So what's kind of been clarified over the past couple rounds of regulations is, what does that substantial improvement mean? And one of the things that came out that really helped clarify this is that you have to improve the basis of a building you buy by 100%. But you don't have to improve, a land basis. There's no land basis kind of metric there. So the idea is if you buy a property for $10 million and 40% or $4 million gets allocated to the building and $6 million to the land, you need to put in an additional $4 million into the project, bringing the total spend to $14 million in order for that to qualify as being substantially improved property and kind of having like a new product. When, these rules and stuff come in to be explained with these regulations, I always want to go back to what was the intent of the code and the act. And the idea is that they don't want people just buying, an existing office building or something that's already been fully developed in one of these opportunity zones and just parking cash there for 10 years and pulling it out tax-free. The idea is they want money to go into these opportunity zones to really improve the area. And so not just buying that office building, but then going in and putting in more money to make it better. That's the idea, is to make these places better.
Got it.
So that's kind of been one of the biggest kind of constraints and explanations that needed to get made on the purchasing of real estate or assets in a fund. Now, from an investor standpoint, after you sell your stock, you have 180 days to invest that realized capital gain into a qualified opportunity zone fund.
Okay, very good. Thanks for the clarification there. By the way, the doubling your basis, the reason that we as a company have not been involved in one of these funds is that it's slightly outside of our risk profile. So for a typical deal, we may buy a property for, let's say, $6 million. And to your point, let's say $5 million is attributed to the actual building. There may be a case where we would add an additional $2 million of capital expenditure to that asset, let's say taking it from a B-class property to an A-class property. But to double our basis would require a little bit more significant of a capital expenditure than our investors are accustomed to, generally speaking. Now, there's an incredible appetite for slightly higher risk investment vehicles than what we put out, but it's just what we've positioned ourselves as a company. Just wanted to clarify that for anyone that's interested. So you also mentioned the original use. Could you explain the original use? I just want to make sure I understand it and for the listeners as well.
So basically the idea is if you buy a building that's been vacant for 5 years, that would qualify as original use and you wouldn't have to substantially improve it. That's kind of where the distinction and clarification comes in. And that was further expanded upon in the regulations that came out last month.
Do you mean that it was in the original use was to have someone in it? Or what do you mean by that?
It's basically the new original use for the new buyer. So if a building has been vacant for 5 years and no one's been using it, the IRS has said that if you go in and buy that building, it'll count as original use and you don't have to meet the substantial improvement test.
Oh, I understand. Okay, got it. All right. So that and then the 180 days you have to double it there or to reinvest it there. Okay. So how significant can you invest any dollar amount in these funds? Like, is this limited to accredited investors typically, or is that not a function of the regulations, or has that not been decided yet?
Yeah, that's not a function of the regulations. That more gets into kind of securities rules and regulations that the SEC governs. So, these would be your standard kind of investor profile of being accredited investors when people are going out and bringing in basically people they don't know into these investments. If, a group of friends kind of get together that are not accredited investors and want to do a business or a project together, they're obviously free to do that as long as they aren't, really soliciting the market out there or doing, a large public securities raise.
Okay, perfect. Thanks for clarifying that as well. So is there a reason that this is frequently done in a fund? I believe there's regulations surrounding it needing to be. I'm not 100% sure as to why that is. So I was hoping you can clarify that as well.
Yeah. So a fund in this instance is just a fancy word for any entity. That's really just how the IRS code kind of came out and said a qualified opportunity zone fund invests in this area. And that's just really where the word stems from. It doesn't have to be a traditional fund like you think of, although a lot of people are doing it that way.
Understood.
And for me, when the regs came out in kind of October, November of last year, I saw that there was enough rules in there to go ahead and do this kind of basically on a property by property basis. When you're trying to do like a multi-asset fund or a very diversified fund, there just seem to be a lot of rules and regulations around, capital coming in to the fund, when that capital has to get deployed into investments. And there just seemed like a lot of steps along the way where a fund or an investment advisor can kind of get tripped up along the way. And it didn't seem to be there was any really rules around either recycling capital or selling assets, along the way during the life of a fund. Usually private equity funds want to recycle capital as much as possible during their 5 to 7 year life, because the sooner you sell a building, the higher IRR is and the more into the promote the sponsor is going to get.
Mm-hmm. Okay.
So with the April regulations, they did come out and kind of give some initial guidance on what a diversified fund could look like. And they more or less gave them an opportunity to invest the capital. Like if you sold an asset, you basically have a year to then reinvest those proceeds into another opportunity zone investment. I think that area needs to be explained a little more because it doesn't feel in line with the intent really of the bill, because you can invest into one, opportunity zone, which is an impoverished area. But then if you pull your money out 3 to 4 years later and then move it into another opportunity zone somewhere else, it doesn't really seem like you're in it for the long haul for that community you're investing in up front. So it'll be interesting to see if they further clarify that you must, reinvest into an opportunity zone within kind of maybe the same proximity, or if you're really just allowed to invest it really into any opportunity zone across the country. It'll be interesting to see if they clarify that along the way.
Makes a lot of sense. And I think you're completely right regarding the intent of the regulation. So similarly, what product types or asset classes do you think are prime for this?
It really is product type agnostic. And I think it really more comes down to the strategy and risk profile that you mentioned before. Like, since you have to either buy this original use or improve the property, which is really going to be the most sought after type of way to go after this, is you're going to have to be doing either ground up development or really heavy value add on these projects. So that can really apply to any asset class. I think a strategy that might be hard to do is taking, C-class apartments and turning them into B apartments or A apartments. I think that strategy is hard to do in an opportunity zone just because the capital that goes into those kind of projects isn't as significant as a heavier value add or lift or a ground up development.
Okay, that's actually a good point, because this has been another reservation that I've kind of brought up to investors regarding that. So there has been deals that I have seen where that's the main thesis, right? We're taking a C-class apartment, we're turning into an A-class apartment. I'm over here thinking, okay, you're going into an economically distressed area where the point is to provide affordable housing, clearly. I have a feeling you're going to have a problem with that particular city giving the right to create luxury housing in the distressed area. And I'm not so sure that there's going to be a lot of demand for that product type. So kind of speak to that regarding the potential challenges with dealing with the city and getting entitlements and how it relates to, specifically the distressed areas, given that's the focus of the regulations.
Yeah. So, some cities have really gotten on board with these opportunity zones. Some of them are very familiar with it. They're very pro-development. They realize this is a great way to attract capital to their cities or parts of their cities or counties that haven't had capital attractor to them before. And this is just, an even better incentive. So a lot of cities and planning commissions have, become really amenable to working with developers to find a way to make this work out. And like you said, it is an interesting dynamic there where you're going into what's considered a low income community, but with the way prices are for, land and labor and materials, that you're really going to, have a high cost to go into this. And so a lot of the time, new development will only pencil for luxury, as you said, but then who's going to be the market buyers for those luxury apartments in these markets? So some areas are going to have a hard time meeting those just economic, market macroeconomic measures. Other places, are already kind of set up to attract those luxury rents. For example, we're in Los Angeles here, and most of Hollywood and almost all of downtown LA and the arts district is an opportunity zone. And it's really interesting how this came about is because when they looked to find out what are these communities or low income communities that are really need of development and additional capital attractors, they based it off the 2010 census. So these rules came out in 2018 where these zones were designated. And so you really had, 7 to 8 years where a lot of these communities were already, on the path to greatness and attracting potential tenants and users of real estate that can pay those luxury rents. And so it's just kind of furthering the process of making communities that were on their path to greatness, greater faster.
Okay, so that is an absolute bombshell, which I had not heard before, which is that the data was taken from the 2010 consensus, which AKA the heart of the recession in California in particular. That is really, really significant. So it's not surprising that a place like Hollywood, for example, or particularly the arts district might apply for an opportunity zone back then. And certainly most likely, if they were to take the data based on more recent years, most likely wouldn't. So that's actually really interesting. So now it does paint the picture as to why you could find an opportunity zone that is prime for luxury housing, but would also apply for these really favorable tax situations. Is that kind of a fair estimation there? I kind of just summarized what you said, but I just want to make sure people are understood that. That's the first time I've heard that, and that makes a lot of sense.
Yeah, that's a great point. And, we're just local to Los Angeles, but these kind of opportunities or mismatching of the data to reality pops up all over the country.
Interesting. Okay. And just out of curiosity, because I know that a lot of our listeners are all over the country, have you found anything else in terms of market dynamics that may paint a similar picture? And if it's outside of your area of expertise, totally makes sense. I'm just interested, had to ask the question given our national focus.
Yeah, so I'm comfortable kind of spilling a little bit of a not too closely held secret here is if you think about universities and the areas around universities, those are mostly inhabited by students. And students are low income individuals, but they're not the ones paying the bills. So a lot of areas around universities across the country have been designated as opportunity zones.
Interesting. That is also a really interesting takeaway. So if you guys are thinking about getting involved in this space, that is an interesting niche to focus on, given that reality, particularly that most students do not pay their bills, but they are, through an affiliate, let's call them mom and dad, able to do so. So obviously a big challenge with, dealing with LA in particular, which I know is your focus, is the entitlement process, which will most likely be necessary if you're going to be completing some development. Have you found a way to mitigate those challenges, getting started the process earlier? What do you think about the entitlement process specifically as relates to the opportunity zones, given the favorable tax situation? Do you find that certain municipalities, maybe certain little areas, are going to be granting those entitlements more likely because of the focus on the opportunity zone, or what are your thoughts there?
I wouldn't put much faith into maybe big megalithic cities like Los Angeles being able to move any faster just because of a federal regulation of opportunity zones coming in. Whereas maybe smaller, nimbler cities like in Santa Barbara County, where I'm working on a project, would be more amenable to working within the time frame. That being said, with the entitlement process, there's quite a few ways to kind of be creative around working around this. So one is you can go into a new development and take it down with, call it 99% traditional equity and new 1% opportunity zone money. And as you get along further on the entitlement process, bring in more opportunity zone money to buy out your original equity capital in order for them to meet their rules around deploying the capital in that way. So there's a lot of ways to get creative between, both equity structuring and then debt structuring as well, where if you want to get in with all of your opportunity zone money up front, get that deployed, maybe overcapitalize the project a little bit with equity and under borrow on your loan. That way you can kind of have a buffer of having more construction or improvement financing down the road instead of having to call additional opportunity zone capital down the line. So there's different ways you can be creative in your own capital stack to work around the entitlement issues and timing with the cities around there.
Yeah, it's a good point. And actually, it reminded me of a deal that I wasn't directly involved in, but had some intimate knowledge of, which was someone who wanted to allow and facilitate someone else to 1031 into another property. And the way that they did it, because the timelines didn't line up perfectly, the property they were anticipating 1031ing into needed to close before the other property did. So they purchased the asset, and then there was an equity buyout once the 1031 money was available. And so you can do the same thing here. So that's actually a really good point, which I didn't consider. So interesting. Now, don't get it twisted. You definitely want an attorney to help you do something like this, because the whole point is if you make a mistake with this, the really advantageous tax situation may be avoided. And that's not what you want to do. So combination of a great attorney and a great CPA is really, really needed for doing anything like this, especially when you're pooling investor capital together. That goes without saying. So here is the mother of all questions. I'm definitely interested in your perspective on this. I know that you take the market cycle very seriously, and I know that you've been very cautious about the reality of what's been going on over the last 10 years or so in the real estate business. What are your thoughts on prices in California in particular, and the combination of that and incurring development or at least very significant capital expenditure risk to facilitate these types of opportunity and zone investments?
So first and foremost, I think that in any up or down market, as I've seen over my career, there's an opportunity for investment somewhere, someplace, in some strategy. So whether we're up, down, or sideways, there is a way to make money in real estate and in business out there. As far as we are in the cycle right now, I think we could potentially be coming into a temporary recession. I don't think it's going to be as great as we really hit in 2008. But as it's been said kind of over the panels over the past 10 years, people are always questioning, like, what inning are we in here? And to me, I don't think we're playing baseball anymore. I think we're playing cricket. I think we're in a really long, extended cycle. And, these cricket games can go on for days. They don't really have the 9 set innings like we do in baseball. Or we could be going into, really extra innings, to take it back to the baseball analogy. And for me, this really comes back to the macroeconomic environment of being constrained with these large amounts of debt at really every level across the world, most specifically the governmental debt of the nations of the world. I think that because of where we are, not just the United States, but Europe, Japan, even China, they've all really leveraged themselves over decades that we're kind of trapped into this cycle of having large outstanding debts where they can't really, move interest rates up super high because it'll bankrupt them. So we're in this really world of low yield, and it's going to be hard to find, investments that pencil, like you said, but they are out there.
Interesting. I really like that perspective, and I appreciate and will likely use your quote about playing cricket going forward. I'm sure the listeners have picked up whenever someone says something interesting, you'll hear me repeat it for like 100 episodes in a row. So I appreciate that little tidbit there. And in terms of kind of the uncertainty, you mentioned that it's pretty solidified regarding the tax benefits, but how are you monitoring how these updates are being given? Are there specific dates at which the federal government has said, we're going to be updating you here, here, and here? Of course, not that they would keep those promises to you anyway. But for the listeners at home, how can you be the most knowledgeable person in the room when it comes to opportunity zones? Where are you getting that information from?
This information is so really highly watched right now. You're going to find it in major publications like the Wall Street Journal or Forbes. Forbes really had the best kind of overview of the last regulations that came out. They got their guidance out within a day or a couple days after it came out. So the major publications are going to be out there explaining stuff, getting involved with your attorneys and CPAs who specialize in either real estate or investment funds. They're putting out email blasts anytime new regulations come out. There's a lot of focus and excitement around this opportunity zone investments right now that, basically every service provider working in this space is going to be on top of it and educating their clients along the way.
Okay. Yeah, it's the fair point, especially since the reason I asked, though, is that when I first heard about this, the excitement was there, but the knowledge simply wasn't. And it was like this big question mark. And then I saw a bunch of money jumping into these funds. I was like, we don't know how this is going to play out yet, So it's interesting to see where this will go, and we'll definitely be kept abreast of it. And if there is any significant changes, we'll definitely have you on to kind of discuss that. So before we jump off, any final thoughts regarding the opportunity zones? I'll obviously give you an opportunity to discuss your firm and what you do over there. But anything else that we didn't touch on yet? I know it's a massive topic. We've covered a lot of ground already.
Yeah, there are a lot of rules into this. I've really only touched on a few high-level ones. In addition, this was a great real estate bill and real estate investment incentive. But really the idea that, Sean Parker and EIG had at the beginning is this would be great for spurring investment into businesses in these opportunity zones. So the last round of regulations helped clarify what those rules would look like and made it really more favorable. So there's going to be huge private equity and VC play into these opportunity zones as well. And people are calling that kind of phase 2 of this program, where phase 1 was the real estate.
Right.
Because real estate's easy to understand, the properties in the zone. Whereas if you're a business, like if I just have a laptop in a zone, does that count? How do I really qualify as an opportunity zone business? And the last round of regs really helped clarify that.
Interesting, which I don't know very much about at all. So is that rolling out currently, or is that already rolled out?
I'm not so much involved on the business side of this.
Okay.
I think there are a lot of funds and investment advisors, really targeting this from that side of the perspective. And people were really waiting for this round of regulations to clarify that aspect of it. Because think about the benefits of that. Like if you're an IT service company, you can really just house your employees anywhere, house them in an opportunity zone. And let's say you start the next Facebook or Uber or, big tech startup, you sell that company down the line or IPO, 10 years later, let's say your company's worth $100 million now, and you sell it at that price, you pay no tax on that gain. I think it's such an opportunity, not ironically said, for these private equity businesses to get into this space in that regard.
Oh, yeah, it would be very similar to like the Puerto Rico situation, which is also very favorable. And not only does it work for IT companies, I think it might work quite well for real estate investment companies. So if the census data is used the same one it's used there, we're moving to Hollywood. Everyone, new announcement. It's about to happen. All right. So before we jump off, James, just want to give you an opportunity. Let the listeners know more about your firm and how listeners can get in touch with you.
Yes. So I formed a company called Stonehan Capital, specifically to target investments in opportunity zones. And I'm partnering with developers who have either or both product type expertise in building or are very knowledgeable about building and developing in their local markets. To me, real estate is a local game. And so you want to make sure that you know how the city works, who the contractors are in the area. So my goal with Stonehan is to create a platform that connects investors with these best developers in these opportunity zones.
Awesome. And how the listeners can get in touch with you?
My website is stonehan.capital, and I can be reached at jb@stonehan.capital.
Awesome. Well, James, thanks again for coming on. Really appreciate the updates and a lot of great information here. So thanks again.
Thanks for having me, Hunter.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.